I bought 50 individual stocks before I turned 30. Every single one of them lost me money. Not because the companies were bad, because I was exhausted. I was trying to outsmart a machine that I did not understand. I was working full time in human resources, moving between countries for my career, and spending my nights researching quarterly earnings reports in a language that was not my first. I thought that was what investing was. I thought you had to be a detective. I thought you had to find the hidden gem. The truth is the opposite. The truth is that the most boring, invisible, overlooked vehicle is the one that actually builds wealth. And I did not find it until I landed in Canada. My first real investment in this country was a single ETF, VFV. The S&P 500 index fund traded in Canadian dollars on the Toronto Stock Exchange, and it solved a problem I did not even know I had. You are losing something right now. It is not just money. It is the thing that money is supposed to buy you: time, mental space, the ability to sleep without running a mental spreadsheet of your portfolio. If you are new to Canada and you are sending money back home for a family business or a property purchase, you feel this deeply. You are managing two currencies, two tax systems, and a feeling that you are falling behind in both places. If you have been here for 20 years and you are still holding a savings account that pays less than 1%, while inflation eats away at your purchasing power, you feel a different version of the same pain. The quiet panic that you did the hard part right. You showed up, you worked, you earned, but you never learned the mechanism that actually turns a paycheck into lasting wealth. Let me put a number on the cost of not knowing. The Financial Consumer Agency of Canada ran a survey in 2021. Nearly 40% of Canadians said money is a daily stressor, not a monthly worry, a daily one. The root cause was not how much they earned. It was a lack of confidence in how to deploy the money. Now pair that with a 2019 Statistics Canada data point. The median net worth of an immigrant family in their first 10 years was roughly $126,000. For a non-immigrant family, it was close to $487,000. That gap is not about laziness. It is about a knowledge transfer problem. The financial rulebook you learned in one country does not translate directly to another. The tax wrappers, the registered accounts, the way credit history compounds. If nobody hands you the translated playbook, you default to cash, and cash in a high inflation environment is a slow bleed. Now let me give you the evidence that single stock picking is a game designed for you to lose. Spiva Canada is the research arm of S&P Global that tracks active fund managers against the market index. Over a 10-year period ending in 2022, more than 88% of professional Canadian equity fund managers failed to beat the S&P TSX Composite Index. These are people with Bloomberg terminals, PhDs in quantitative finance, and teams of analysts working 80-hour weeks. 88% of them cannot beat the market over a decade. If the professionals with infinite resources cannot do it consistently, you and I checking our phones between meetings do not stand a chance. The market is not a puzzle to be solved. It is a wave to be caught, and an ETF is the surfboard. A second data point comes from BlackRock Canada. They are the largest ETF provider in the world through iShares. Their capital markets report in 2022 showed that trading volumes for what they call asset allocation ETFs had jumped over 400% in 5 years. These are ETFs like XBAL or XGRO that own a diversified mix of global stocks and bonds inside a single ticker. The market is moving away from stock picking and toward automatic low-cost portfolio construction. The smart money is not trying to be brilliant. It is trying to be efficient. And a third point, the one that hits closest to home. Compare a standard Canadian mutual fund with a management expense ratio of 2% against a simple S&P 500 ETF with a fee of 0.09%. On a $100,000 portfolio, the math is brutal. The mutual fund eats $2,000 in fees this year. The ETF eats $90. The difference compounds. It turns into a new car, a year of university tuition, or a down payment on a property. The industry does not advertise this gap. They hide it in long documents and confusing language. But the fee is the one thing you can control. And in Canada, where banking oligopolies dominate the shelf space, they have every incentive to sell you the expensive product. So why did I choose VFV? Let me tell you exactly what I was seeing in my own life. I had spent years working across Asia and the Middle East. I was buying single stocks in emerging markets. It was a tedious process. Every purchase felt like placing a bet on a horse I had only seen in a photograph. I kept researching, kept hunting for a vehicle that would monitor and adjust itself across hundreds of companies without my intervention. When I finally understood what an ETF was, the logic clicked instantly. It was a bucket that held the top 500 companies in the United States. Apple, Microsoft, Johnson & Johnson, Visa, all of them in one trade. But the deeper reason was currency. I was moving toward Canada. I was about to earn and spend in Canadian dollars. I did not want my investment returns to be destroyed by a swing in the foreign exchange rate between the US dollar and the Canadian dollar. VFV is an unhedged S&P 500 ETF. That means it trades in Canadian dollars but gives you direct exposure to the US market and the US dollar. If the US dollar strengthens against the Canadian dollar, my investment goes up in Canadian dollar terms, even if the stocks are flat. For someone who travels, who buys goods priced in US dollars, who thinks about global purchasing power, that currency exposure is not a risk. It is a hedge. It is a protection. I did not start with a massive lump sum. I started with whatever I could automate. My first purchase was not a celebration. It felt anticlimactic. I clicked a button, the order filled, and then I did nothing. That was the proof moment for me, the silence after the trade. I had been conditioned to think investing required adrenaline. It does not. It requires a system that runs in the background while you live your life. And that system in Canada runs on two rails, the registered account and the low-cost ETF. Now, let me give you the framework. 5 steps you can act on this week with your existing Canadian bank accounts from wherever you are sitting right now. Step 1. Open the right bucket first before you buy a single unit of anything. In Canada, the Registered Retirement Savings Plan, the RRSP, and the Tax-Free Savings Account, the TFSA, are not just savings accounts. They are tax shields. If you are a resident with a valid social insurance number, you have contribution room accumulating every year. The CRA provides this number on your notice of assessment. For a newcomer who just got their first job offer, the instinct is to open a non-registered cash account at the big bank. Do not do that. Walk into the bank or log into your online portal and open a TFSA. All growth inside that account is tax-free. You can withdraw at any time. You do not declare a single dollar of profit to the CRA. That is real wealth protection. For someone who has been here 20 years and still holds a high-interest savings account inside a TFSA, you are wasting the shield. A savings account earning 2% inside a TFSA is like putting a bicycle inside a Formula One garage. It fits, but it misses the entire point. Step 2, pick one broad market ETF that matches your life, not your opinion about the news. I chose VFV because I wanted the S&P 500 and I wanted it priced in Canadian dollars without currency hedging. That was my thesis. Yours might be different. Maybe you want a global approach. You could look at XEQT from BlackRock, which owns stocks in Canada, the US, and international developed and emerging markets all in one fund. The management expense ratio is around 0.20%. For every $10,000 you invest, you pay about $20 a year in fees. That is a dinner for one person at a mid-range restaurant in Winnipeg. That is the cost of owning 9,000 companies across the planet. The key is not to hunt for the perfect ETF. The key is to pick one that is broadly diversified, has a management fee under 0.25%, and is from a major issuer like Vanguard, BlackRock iShares, or BMO. Then you stop shopping. The comparison is the trap. Pick, buy, and move on. Step 3, automate the buy and ignore the price. Most people in Canada get paid on a bi-weekly cycle. The money hits the account on a Wednesday night or a Thursday morning. The banks want you to let it sit in a checking account at 0.01% interest. You need to break that default setting. Log into your online banking. Set up a recurring bill payment or a pre-authorized deposit to your discount brokerage. Even if it is $50 every 2 weeks, schedule it for the day after your paycheck lands. Then set up an automatic purchase plan for the ETF you chose. Wealth Simple Trade offers this. Questrade offers this. The big bank brokerages are slowly catching up. The point is to remove the decision. You are not timing the market. You are capturing the average price over 10, 20, 30 years. The system does the heavy lifting. Your only job is to not interrupt the system. Step 4, understand the Canadian fee trap that has robbed a generation of wealth. I mentioned the management expense ratio earlier, but you need to know where the trap door is hidden inside your own current investments. Go to your online banking right now and find your investment account. Look for a mutual fund holding. The ticker might start with an RBF or a CIB or a TDB, which stands for RBC Funds, CIBC, or TD Bank. If you click into the fund details and see a management expense ratio above 1.8%, you are paying the bank's mortgage more aggressively than you are paying your own. The script to use when you call the bank is simple. You say, I am reviewing my investment fees, and I see the MER on this fund is over 2%. Can you confirm there is a lower cost ETF version of this same exposure available through your platform? If the advisor deflects, do not argue. Open a discount brokerage account. Initiate a transfer in kind if you want to delay taxes, or liquidate and move the cash if it is inside a TFSA or RRSP where there are no immediate tax consequences. This one conversation can save you tens of thousands of dollars over a working lifetime, and it takes less than 20 minutes. Step 5, file your taxes with intention, even if someone else does them for you. The RRSP is a deduction that lowers your taxable income now. The TFSA is a shelter that protects your growth from tax later. The First Home Savings Account, the FHSA, is a new hybrid that does both for a first home purchase. If you are a permanent resident or citizen earning a salary in Canada, these accounts are not optional extras, and they are the architecture of wealth building here. The mistake I see across every income level is people funding their unregistered margin account before they have maxed out their TFSA and their RRSP. That is like paying for groceries with your credit card while your wallet has cash in it. It makes no mathematical sense. When you sit down with your tax preparer or your software this spring, ask one specific question. Am I using all my registered contribution room this year? That question alone forces the conversation. It changes the plan from reactive to proactive. The framework is the mechanism. Open the registered account. Pick a single, low-cost, broad market, ETF, automate the purchase, audit the fees, use the tax shield. That is the entire playbook for the first decade of your investing life in Canada. Everything else is noise. The hot stock tip from your coworker, the crypto narrative, the fear about the next recession, all noise. The signal is simple. Own a piece of the global economy, protect it from taxes, and let time compound. This channel exists for one reason, because nobody handed you the rule book. You arrived in Canada with ambition and a work ethic, but the financial industry speaks in a language designed to confuse you into expensive products. We are fixing that here, one concept at a time. The cost of ignorance was the stress, the missed gains, and the decades of compound interest you cannot get back. The cure is a system that runs so quietly you barely notice it. That is what an ETF inside a TFSA gives you, a silent, tax-free wealth engine that you do not need to micromanage. If this is your first time on Global Career Wealth, hit subscribe now. This is not surface-level motivation. This is the operational detail that turns a paycheck into a portfolio. The next video takes the next logical step. Once you have your first ETF and your registered account set up, the question becomes how to survive a downturn without panic selling. I will walk you through the exact mental model and the mechanical rule for rebalancing during a market crash. That video is called When the Market Drops 30%, a Canadian rebalancing protocol that keeps you invested. Watch that next. See you there.